Individual psychology of a trader. There was a professional trader and money manager in Chicago. He's dead now, the guy by the name of Brian Monison. And he famously said in an interview, I have a PhD in mathematics, I specialize in cybernetics, but I was able to overcome these disadvantages and make money. Being highly educated is a negative when it comes to trading. The more formal education you have, the bigger the obstacle you have to overcome. Why is it so? We're dealing with only 5 numbers: open, high, low, close, and volume. There is nothing terribly hugely sophisticated about it. I mean, you have to be able to count, and you have to be able to count on your feet. If I say to you 20% of 87, approximately how much it is, I'd like you to be able to answer that question without a calculator. Those things you have to do on your feet, but you certainly don't need algebra, you don't need higher math. Emotionally, trading is the hardest game in the world, and it's so terribly hard because like nowhere else, the game is entirely up to us. The game begins when we put on a trade, and the game ends when we take off a trade. There is no structure. We create our own structure. So the question that used to bother me for the longest time, why do intelligent people keep losing money? Because the game really isn't that hard intellectually. And I finally realized they were trading for entertainment. Trading for entertainment, trading to show off in front of others, like this poor fellow who is losing his spot in Spike Group. Entertainment, to escape from the dullness of everyday life. What do we do about it? Well, the easiest time to talk about discipline is today, because it's a Sunday, markets are closed. Everybody is so disciplined. But let me see how disciplined you're going to be tomorrow morning when ticks start coming in. And that's, by the way, where record keeping will come in place. Later today we will be talking about how important it is to write down your plan and then just work from your plan. One of the problems that people have with trading and with life in general is being mindless, just doing things because that's how we're used to doing things. But the important thing is to be mindful of what you do, paying attention. Here, just at the end of this chapter on individual psychology, in an effort to be mindful, I use this daily psychological self-test. In the morning, when you prepare to trade, you've got to ask yourself, how ready am I to trade? Because you, your mind, your personality are very much parts of trading success or lack of such. And so I use this 5-line thing. How's my physical? How am I feeling physically? If I'm feeling unwell, 0 points. If I'm okay, 1 point. If I feel just full of energy, 2 points. We'll be coming back to this five-point business several times today. There was a woman here in New York. Her name was Virginia Apgar. And those of you who have anything to do with medicine probably heard about the Apgar score. And a child is born, a baby is born, and baby has to be very quickly evaluated. Is it okay or is it not okay? If it's okay, just wash it up and put it into general care. If it's not okay, get some help, and or some cases you have to call a reanimation team. And Dr. Apgar developed a 5-point objective test that anybody can administer. You don't have to be a physician to do that. Color, if the baby is pink, 2 points. Baby is white, 1 point. Baby is blue, 0 points. Breathing, how often the baby breathes. Response to a pinch, baby screams, 2 points. Baby withdraws arm, 1 point. Baby doesn't react to a pinch, 0 points. So 5 questions, 5 answers. An answer to each question is 2, 1, or 0. And if the score is 7 or higher, baby is fine. If the score is 4 to 7, it's trouble. Below 4, we really have a major trouble. And in any case, the value of a simple test. So I ask myself, how do I feel physically? How was the previous day? If I lost money, 0, mixed or no trade, 1. If I won money before, 2 points. How prepared do I feel? Not prepared, middling prepared, very prepared. How's my mood? Bad mood, middling mood, great mood. And how busy I am? Very busy, just usual, and I don't have anything much on my plate. It takes me less than a minute to take this test. I score myself, and if my score is 4, then I should not be trading. If my score is 5 to 6, be careful. 7 to 8 is great. If my score is 9 to 10, be very careful again, because if everything is so fine, it can only change one way. So, individual psychology of a trader. Solution to the whole thing is written trading plans. Good record keeping. Before we go to good record keeping, which is a hugely important topic, let me pause a little bit and talk about the question that I was asked during the break. How do I scan for stocks? I have 2 ways of looking for stocks. One is lazy, and the other is hardworking. Which one do you prefer? Lazy. Lazy. Me too. Lazy way is this. I go to spiketrade.com, log in, and we have these elite level traders, we call them spikers. We have 13 spikers now, and they submitted these picks. Now these guys are competing for cash because they get bonuses. People who are positive at the end of the quarter get bonuses, and for glory. And I think they value glory a lot more than cash. So we have these spikers, and these are their picks. So I click on direction. I click on sort, and so now I have all the longs on top, and I have all the shorts at the bottom. I go to Spike Trade. I open this special layout that I have, and so I'm bearish. So I'm looking at spikers who submitted short picks. These are smart guys who are really who doing their research and who are trading to win. So we have 4 short picks. Jim, who is one of our oldest members, he's about 80 and very, very savvy guy. He is shorting PPC. I don't think so. Impulse system is green on the weekly. Impulse system is green on the daily. There is no trace of a divergence. How to short that? Scratch me out. And Vladimir is shorting TDC. I don't see it as a short. I see it as a buy more than anything else. I'm not looking for complicated trades. I'm looking for easy money. I'm not looking for a challenge. I'm looking for something that will grab me by the face. So let's see, Sid, who is a very careful guy, is shorting SPY. Let's take a look, SPY. I can go back to Spike Trade and see what is Sid saying about SPY. SPY stopped me out last week, owes him money. This still looks stoppy, and QQQ is trying to hold below. IWM is also diverging. Daily is creating divergence on a MACD histogram. Also a lot of reversal and dodgy days. It's tricky. I feel this could be another whipsaw week, and small movement up and down can stop you out. I'm going to look out for 78-minute chart to enter the trade. This is where I look for my trades. This is option A. You know, I look at all these smart people making their picks, and I follow them. And Sid wrote a very sensible thing, how he is bearish, but he got stopped out last week. It could be another week like that. He is cautious. He is not jumping in. Let me show you a more hard-working way of looking at those things. I do a scan of potential and actual MACD divergences in all S&P 500 stocks. How do I do it? Most people try to write a divergence scan, which I don't think can be written. And a divergence scan, well, here you see red dots popping up. What does it mean? You have a peak of a MACD histogram, a break, and now MACD is coming positive again. Prices are challenging the old peak. Red dot, you see? And it's not really a divergence yet, it's a potential divergence. And so I get a list of potential divergences, and then I eyeball them to see which of those things I'm going to trade. And it worked out quite nicely. So I did the scan yesterday. I found that among 500 S&P stocks, there were 6 bullish signals and 58 bearish signals. I think there's a message somewhere there. And then I eyeballed them to see which ones I like. So I found one bullish chart that looked interesting. FLR doesn't look bad at all. A downtrend, break below lower channel line, pull back to value, a break to a lower low. So all stops get wiped out, and the stock closed actually higher for the week. Am I going to go and buy it? Nah, I'd rather be shorting here. But it is a legitimate buy. I think it will become a legitimate buy if it trades above 62.35. It went out at 62.39 on Friday, so it's just about there. Look at the daily chart. So, no diversions, no nothing. But in any case, that was a weekly pick. Let's take a look at the bearish signals. How about this one? SO. I think looks interesting. Take a look. We have a false upside breakout. The impulse system turned blue. MACD histogram sliding. Force indexes diverging. I mean, I look at something like this and say, hey, this is something. Let me work it up. I go to the daily chart. Is this a thing of beauty or it is a thing of beauty? We had, on Monday, it broke out to a new high. It traced a beautiful bearish divergence on the daily charts. Right? So now we decide if we sell it short, three numbers, entry, target, stop. I mean, this is like a trinity, right? Without it, you cannot go anywhere. Entry, target, stop. The distance from your entry to your stop, the amount of capital you're planning to risk, the average true range, and get ready. How about this one, ETR? It broke out to a new high and is not having a huge amount of progress, does it? And actually, on Friday, it completed a false upside breakout, by closing below support. There is a bearish divergence on the weekly chart, and there is a very nasty looking daily chart as well. You see this one-day rally. This is where stops got run, and it's sinking now. I mean, it takes me an hour maybe to do this kind of thing, and you find 5-6 stocks that look very interesting. Now you start working them up. Just keep in mind, this is not an automatic trading system. Basically, you dig up, it's like digging up iron ore from the ground. It's enriched iron ore, but it still requires processing. Let's take this couple of tickers we discussed, and let's do real homework. Daily homework spreadsheet. I call it trade scan. It's 12/7 today, right? And we found these stocks, SO and ETR. So we're thinking of shorting, right? So now we need to work up these stocks. So item number 1, someone asked me earlier this morning, do I watch the news? And I said, the one piece of news I'm always on top of is earnings, because I don't want to run into an earnings report. So I click, and I have a link there which says FinViz, which is a wonderful research website. I click SO. Earnings were October 29th, so no worries about earnings. So 10/29, we're in good shape. And ETR, earnings November 4th, again, we're in good shape. So the next item I want to check is what is the short interest in a stock. In futures, the sheer number of long and short contracts is always equal, exact. But not so in stocks. In stocks, you have very few shorts. But occasionally, you have a stock which has a very large short interest. And it's very good if you buy. If stock starts rallying, those shorts will run. And as they cover, the stock can go vertical. So if you're buying and a stock has a large short interest, it's a good thing. It's like an extra fillip there. If you're shorting and the stock has a very large short interest, then you're joining the crowd. Let's not. So let's check what the short. By the way, last week you can see here, I had 3 candidates. I showed you one of them, DDD. The impulse system stayed red, but short interest in DDD was 35%, which is enormous, enormous short interest. So for a buyer, it's a very good thing. For a short seller, I wouldn't touch it with a 10-foot pole. Another stock I was considering last week was Tesla short, and short interest in Tesla was 23%. I would not sell short a stock with that high short interest. Once it goes into the teens, count me out. Days to cover, again, there is a free website, shortsqueeze.com, and SO, shorts as a percent of float, is 4%. Days to cover is 6. This site, shortsqueeze.com, it says short percent of float, meaning, okay? So short percent of float below 10 is normal. Low single digits is even more normal. Above 10, alert, into the teens, I would already be reluctant to sell it short. And another thing, this is somewhat artificial number, days to cover. If all volume was dedicated to covering shorts, how many days it would need? 6 days. Let's do the same query on ETR. Short percent of float, 498%, 5%. Days to cover, 4 days, 3.8 days. No problem, no objections. Well, let's do SO. Next, I look at this thing. The question, my spreadsheet asks, at what level will impulse system go blue? It's already blue on the weeklies. At what level will it go blue on the dailies? It's already blue on the dailies. Right? So I have no problems at either one. Blue, blue. And next it asks me, what is the 1 ATR in SO? So SO 45.27, 45.93. So 1 ATR is about 65 cents. It's 65 cents. And now it asks me, what's your entry price? The moving average is at 47.47. I would say, yeah, somewhere there, 47.47. Well, 47.49. I want to sell a little bit above value. I will sell it short, 47.49. What's your target? I would say this orange line around 45 is a reasonable target. On the weekly, targets on weekly, stops on daily. Stops on dailies. What's your stop? Well, this high was 48.31. That's where stops get blown out. I'm not going there. 48.31. This one, 48.17. 48.14. 48.13. I would say 48.16. How am I doing with ATRs? So my stop is about 65 cents away, is it? I'm shorting at 47.49, protecting at 48.16. So this high was 48.31. I will say 48.39. I'm trying to put my stop off of some kind of chart pattern. So I'm going a little bit above this one. I come back to it. How much am I going to risk? Now, I will risk anywhere from $200 to $2,000 per trade, depending on whether I'm really doing it a serious trade or a play trade. Let's say it's a play trade. So I'm going to allow myself $200 risk. How many shares may I sell short? The formula calculated my risk. I'm risking from 47.49 to 48.39. 222 shares, 200 shares. Now, what happens time and again, I will work up a stock like that, and in the end I'll say, makes no sense. The stop is too far, the target is too close. And so I will be plowing and plowing and plowing and discarding 4 out of 5 stocks until I finally say, this is the one. And this is professional trading for you. plowing and discarding, plowing and discarding. It's not just, oh, okay, SO looks good. Oh, sure, it looks good. Everybody agrees it looks good. Do the numbers line up? It's boring work. I don't enjoy doing it, and I do it. You have one more self-test there with questions, 5 lines of questions. Think about tomorrow, and if it was the morning, fill out the boxes and rate your readiness to trade. Start using it and start changing it, but the whole point is 5 questions, and in a moment you know, should you be trading today or not? Let's talk about good record keeping. I wrote this book back in 2006, I think, a book of interviews with traders. I finished this book and went around talking to people about it. Many of them said, what do these traders have in common? They are men and women, Americans and foreigners, people who trade stocks, options, futures, people who trade very short term and very long term. One thing they have in common, they all had in common, they had excellent records. Just really excellent records. Show me a trader with good records and I'll show you a good trader. I keep my records in a trade journal, which we have at spiketrade.com. Take a look at the questions. Entry, target, stop. How much will you risk per trade? What is the name of your trade? Each trade has to have a name. Call it a system. Call it a strategy. Each trade has to have a name. So these are my trades. False breakout with the diversions, pull back to value, fading an extreme, trading against an extreme, and fundamental. And that's all I have, 4 strategies. So if you tell me, hey, take a look at such and such stock, and it looks attractive to me and I want to trade it, it has to fit one of those 4 strategies. If it doesn't fit it, there is no trade. Each trade has to have a name. Here in the trade journal, it enables me to attach my charts, and then when I exit a trade, I have to classify every exit. Every exit deserves a name. Hit target, hit stop, hit value, hit envelope, trade going nowhere, started turning, couldn't stand the pain. How about that? Couldn't stand the pain. Anybody heard of using stops? Obviously not the person who couldn't stand the pain. Junk trade, have no business being in it. Okay? And now I can pull up my equity curve for all of those trades. What do you think is the difference between my equity curve for hit target and couldn't stand the pain? Okay? But this is how you learn, by keeping records on yourself. Daily homework, just as I do that psychological self-test in the beginning of the day, I do this. So tomorrow morning, before the market opens, I'll click on this link, check Far East markets, and I'll switch from the US to Asia. Why? Because markets go around the globe, Asia, Europe, US, Asia, Europe, US, like a dog chasing its tail. US, of course, is the most important, but it goes in a circle. So I'll look tomorrow morning and I'll see how's Nikkei doing, how Hang Seng doing, how's Shanghai doing. And then I'll go to the spreadsheet and I will write, like I wrote on Friday, up 0.2 to 1.3%. So Asia was strong coming into Friday morning. Next line, how's Europe doing? And I will look at only at FTSE and the DAX. So again, on Friday coming in, both FTSE and the DAX were strong. No surprise that the US market went up. You could see this wave floating around the globe. Asia went up, Europe went up, now we're opening. Chances are very high that this will continue. Economic calendar. But look, for example, on Monday there were no great news. Thursday, jobless claims, retail sales. On Friday, producer price index. You know that those big numbers are coming. They usually come before the markets open. You want to watch how the market reacts to those numbers, how it trades before and after. Market Watch. Market Watch is the most popular website for the trading public. So I want to see what the trading public is being fed today. Check prices of euro, yen, oil, gold, bonds. By now you're starting to get in gear with what's happening in the market. Baltic Dry Index has nothing to do with the Baltic Sea, but has with the price of moving cargo across the ocean, and one considered to be the most sensitive leading indicator of world economy. New high, new low, VIX, S&P. What is S&P related relative to cash? My expectations of the S&P candle. I don't always have an expectation, but when I have, the next day I go back and I color it green if my call was right, or red if it was wrong. And this is my morning homework. A hugely important thing, become your own teacher. When you keep a trading diary, keep your trading records, 2 months after you exited a trade, pull up its chart and mark up what you did right and what you did wrong. Targets and stops. This came from my trading diary. Basically what I try to do in all my trades, I try to buy below value, and this was a very short day trade, daily chart, 25-minute chart. I bought, I held it for 3 days, and I saw a divergence on a 25-minute chart, and I sold it out. Bought below value, bought a bullish divergence, sold above value. What's wrong with this picture? Not too much. Short, little, neat swing trade. This is the stock I shorted the day after our workshop in Alabama. False upside breakout, missing right shoulder divergence. Short, didn't cover here because it was very bearish on the markets, and covered really very low. Covered when it went below the lower channel line, started reversing. But basically my targets are always off of channels and moving averages. I want to buy below value. I want to sell short above value. If we go back for a minute to that IWM trade, we will be released to sell short at 117.05. The moving average is at 116.87. So if I don't grab it above 116.87, I ain't shorting that thing, right? And it's not actually the greatest short even now because it's so close to value, but it's legal. So I want to sell short above value. I want to buy below value. And as far as profit targets are concerned, I think a channel is a wonderful profit target. Right? So that's targets. Let's talk about stops. I already said to you that to me a dumb stop would be below the lowest low. So here, leg comes on down, establishes a low, we put a stop below it. Well, what do you think happened here? You know, the pros know that there are stop orders sitting there, and they just push the market there a bit. And that's why time after time after time, you see how this is the bar at which all the stops, all the easy stops got wiped out. Anybody who bought and put a stop below the 1 cent below the low got taken out here at the worst possible time. That's why I keep saying you want to place your stops outside of the zone of market noise, outside of the zone where the market just goes like that. And lately, I've been using extensively this one tool for placing stops. And that tool is average true range. It's included in every software package that I know of, ATR. Here is this chart of this IWM thing with ATR channels, 1, 2, 3. So what's the distance between those channel lines? The distance is 1 ATR, 1 average true range. So what is 1 ATR in IWM? It's 111.76 to 113. So 1 ATR is close to a 1.5. It's close to a 1.5. So if we're going to put our stop within a 1.5 of the price, we're asking to be hit. So this $1 stop that looked so nice on the charts is probably not such a good idea anymore. I place my stops at least 1.5 ATRs from my entry. So 1 ATR is what happens during the day, so at least 1.5. And 2 ATRs is even better. Man, this IWM looks so sweet on this chart. Rally, break, and this missing right shoulder. Break, and it's holding. Well, maybe it wants to do another run to the top before falling. But putting a stop at $1 away suddenly doesn't sound so good anymore. 250 would be more like it. 3 maybe. 250. So if we put a stop at not 117.05, but at 118.05, where will it be? Approximately here. Yeah, makes sense. So what does it mean if we put a stop that wide? If we decided to risk only $250, we now should trade only 100 shares of this thing. And that's, yes?
When a lot of protected stops are put at the same level, and then all of a sudden, say the stock dips to that price and knocks out all those stops, and then it goes up. Who's causing that dip? Market makers or brokers, or who's doing that?
It's a good question. I was trying to think how to give a short answer to it. Let me preface it by saying I'm no believer in conspiracy theories. I don't think that there is some kind of cabal of traders watching your stop and planning how to hit it. But these guys who've been doing it for many years, they know that stops are there. They know because, first of all, they see it on the charts, and second of all, some of the quote systems show you how many orders are stacked up. Even if you don't place your order, they still see those chart patterns. Stops are sitting.
Who's seeing it? Institutional traders, or who's the one that's seeing that?
We can see it.
You can see it.
Yeah, but I can't knock them out myself.
You can't knock them out, but you can see them. You can see those stops. Okay. So those guys, it's not that they're knocking them out. They see those stops. So now suddenly there's a little swing and prices start declining. And under other circumstances, those guys, they buy weakness, they sell strengths. But they're close to the stop level. So they say, you know what, this thing might very well go all the way down. Let us pull back and not buy. And it becomes a self-fulfilling prophecy. Because these guys see that stops are close. They're not buying because they know that so many times the thing falls all the way down. So buyers pull back, sellers are there as usual, the balance shifts, the stock accelerates down. The stock accelerates down, it hits the stops. Now it's flying down. And now those guys are sitting with their fingers above the keyboard. It flies slower and slower. There's a sale going on. There's a sale. Buy on sale, yeah. So I don't think that it's like there is some kind of conspiracy to do that. It's just these guys see support level is approaching, they stop buying. That's when the volume stops coming in, yeah. Instead of worrying sick about those super fast algo traders, they're chasing pennies basically in a at a very fast speed. They're trying to grab a very fast penny, if that much. Well, is that what you're trying to do? Are you trying to sell short IWM and make a penny? Well, if that's the goal, then you're really competing with those guys. But if you plan to get in and do a swing trade that will last you maybe a week, well, you're in a completely different game. You're in a different ballpark. And what those guys are doing, they're just bringing more liquidity for your benefit. Use limit orders, longer term planning, limit orders. And that's the answer as far as I can see. Trading vehicles. There are 6 major groups of trading vehicles: stocks, ETFs, options, CFDs, illegal in the US but popular in many countries, including Singapore, futures, and Forex. A very good place for a beginner to start is in stocks. Why? There's a fantastic choice there. You have thousands of trading vehicles. You can get stocks in different industries, technologies, everything. You can very easily calibrate what you trade, how much risk or how little risk you're willing to take. And stocks trade pretty much from 9:30 to 4, so that when they close, you have time to think. It's the most peaceful trading vehicle. Now, if you start trading a penny stock, that's a different story, because the penny stock goes up 5 cents, you're up 7%. It goes down 5 cents. But with stocks, I would say try to avoid single digits, especially low single digit stocks, and avoid thin stocks. I don't like stocks that trade less than 1 million shares a day. Below 500,000 shares a day, I will not touch them. So big stocks that you can easily come in and easily come out. ETFs. I'm hugely suspicious of ETFs. Why? There are so many crooked, bad ETFs, many more than good ETFs. For example, you know that volatility is very important, right? Market volatility, and at the bottom you have the volatility index, VIX. From 2010 until today, VIX traded as high as $45 and as low as $11. So fear is high. Shakespeare, when VIX is high, it's safe to buy. When VIX is low, go slow. So high VIX, high fear, that happens at bottoms. Low VIX is everybody's happy, things are dangerous. Where is VIX now at the right edge? Chart updated through. Yeah, it's very low. Now, you want to make money trading VIX? Look how orderly VIX moves. Upper channel line, below value. Upper channel line, below value. Upper channel. I mean, this is a wonderfully, logically, clearly moving vehicle. Why don't we trade it? Well, you cannot trade the VIX, but you can trade TZA, which is a VIX ETF. And the VIX ETF, during the exactly same period of time that VIX oscillated between $45 and $11, TZA went from, hold on to your chairs, $800 down to $14. What's wrong with this picture? This is crooked. this is just bad. Commodity ETFs. I stopped trading them. I traded them. There was a short period of time when I decided to give a spin to commodity ETFs. I remember I had gold and crude oil. Gold went up, crude oil went down, and ETFs did the opposite thing. Avoid leveraged ETFs like the plague. Leveraged ETFs like double, triple ETFs are good for one purpose and one purpose only, for day trading. They track the underlying security in the course of the day, but they are completely off the rails. As you can see, TZA example, they are completely off the rails. So if you like ETFs, I want to alert you that you're looking at no friend of ETFs here. Once in a blue moon, if I have a very strong opinion about the market, I will trade spiders or QQQs. Big, huge index ETFs, no leverage, nothing. Just I'll take a position in the broad stock market for those things. That's all. Okay. Options. Long time ago, this woman came for some private consulting. She was a market maker on the floor of the American Exchange. She says to me, options are a hope game. You can buy hope or you can sell hope. I'm a professional. I come to the floor in the morning and I figure out what the public hopes for. And then I price that hope and I sell it to them. In all my years of teaching, of encountering thousands of traders worldwide, I never once in my life, never met anyone who built an account buying options. Everybody has a good story, myself included, bought an option at 5/8, it went to 17 next morning in a market crash. I was smart. I was holding for more, sold it at 6. But the point is, even 5/8 to 6 is a lot of money. But the point is that every option trader will have a happy story like this. But in the long run, nobody makes money buying options. You're buying a wasting asset. And again, from personal experience, among thousands of traders whom I met, whom I challenged to tell me that they built up their account buying options, I never had one. Flip the page. Have several friends who are grinding good money out of the market year after year after year, writing options. If you're going to do anything with options, you've got to write them. You've got to sell hope. But it requires substantial capital. It requires certain mathematical ability. It requires discipline. Never confuse an option for a stock. Somebody with a tiny account who cannot afford to buy 1,000 shares of Microsoft decides, oh, he's going to buy 10 call options on Microsoft. Well, options and stocks move differently. With a stock, if you're right on the direction and you have the holding ability, you will eventually come out all right. With an option, you can be right on the stock, right on the direction, and lose money because the option will expire before. So stay away. CFDs, contracts for difference. In CFDs, a company sells you a contract based on a market, but they determine the pricing of that contract. So you're playing against a team that has the right, the full legal right, to move the goalposts while the game is going on. Have a nice day. They're illegal in the US, and they should be, and they're legal in most English-speaking countries, as well as in places like Singapore, which should know better. Futures, a deadly market for beginners with negligible survival rates, and a wonderful market for the pros. There is nothing wrong with futures. There is everything wrong with futures traders. Futures require absolutely ironclad risk management. If you have one question about risk management or your ability to follow that plan, stay away from futures. Futures are for people who've got risk management down cold. Wake them up in the middle of the night and they know what they're doing. So futures are very tradable. I love trading futures, but be very careful. And finally, Forex, the wonderful world of Forex. I have this folder in my PageMaker. I call it free cheese. There is a wonderful Russian saying, the only free thing in the world is cheese in the mousetrap. How about this? Forex robot, 500 to 2,000% monthly on managed accounts. I am modest. I'll settle for 500% monthly. How much will I have by the end of the year, and where do I send the money? Here's an ad from Russia. It says income 71% every hour, commission 0, beginning capital $80. Free cheese. And here's an ad from Germany where this guy says he is making 9,000 euros per month, easy. The level of BS that flows is just unbelievable. What's the problem with Forex? When you buy or sell IWM or Tesla or Amazon or something like that, your broker does not care whether you make or lose money. And it's a wonderful thing. Your broker is performing a service on your behalf, collecting a prearranged fee, and that's the end of the game. If you want to buy, let's say, yen dollar or euro New Zealand dollar, gets exotic. Let's say you want to buy euro New Zealand dollar. Your broker will sell it to you. You want to sell short euro New Zealand dollar. Your broker will take the opposite side from your transaction again. So basically, the trade you place with the Forex house most of the time doesn't go anywhere. The Forex house is at the opposite end of your trade. They're bigger than you. They have more money than you. They set the rules. And that's why playing Forex is such a deadly game. If you make money, they lose. If you lose money, they gain. Right? Your broker is your enemy. Why? Why would you go into a situation where your broker is your enemy? Why? I trade Forex, but when I do, I only trade Forex futures. Like for example here, we go to the weekly chart before I make any decision. ECZ14, December Euro futures. So the dollar is rising, the euro is falling. At the right edge, the euro is down, broke down to a new low last week. The impulse system is red. If it trades above, if it holds above 122.33, basically within half a cent range, it will go blue. Prices at a crazy oversold level near the lower channel line. We go to the daily chart. The impulse system is red. The euro broke through support on Wednesday. And nothing. Holding up. It won't take very much for it to reverse, leave behind false downside breakout. I mean, this becomes a very tradable thing, can become a very tradable thing. But my point is, I'm not going to trade it using Forex contracts with a Forex house. I'll do it with futures in Chicago, clean. Okay. We talked about individual psychology, how it's all about self-control and keeping records and having written trading plans, all of which we will discuss. We talked about mass psychology, how the crowd sucks us in or tries to suck us in, and how we need to isolate ourselves from it, making your decisions in solitude and not checking on the website what other people are saying. We talked about classical charting, the problem with which is that it's very subjective. And I stripped down classical charting to just very few logical and clear elements: support, resistance, breakouts. And breakouts can be regular breakouts or kangaroo tails. When I began, I had graph paper. You bought graph paper from several companies that sold it, and sharp pencils. And then I remember buying my first electronic calculator to calculate moving averages. Then I got myself a programmable calculator, which had a little magnetic strip that went through the calculator. Now I could calculate more complicated indicators. And then I got my first computer, which was Apple II Plus, and a first program for computerized charting. Well, fast forward to the present day, and what we have is an embarrassment of riches. We have just too many indicators available to us. A person can just go and look at 50 indicators, or try to see what their combined message is, or if he doesn't like an indicator A, he can go and look at indicator B. I often say to students, if you give me a stock and tell me whether you want to buy or sell, in 5 minutes with my program, I will prove that you are right. There is a wonderful book, by the way, highly recommended, The Paradox of Choice. The guy who wrote is a professor in Pennsylvania. And basically he says, if people have no choices, they are unhappy. You give them a choice, they feel happier. You give them more choices, they become even more happy. You give them even more choices, they become less happy. Because if you have to choose between too many choices, you always feel like you're missing something. So same thing with trading. Let's keep it simple. Less clutter, more clarity. My rule is 5 bullets to a clip. A technical trader is allowed 5 indicators. And if you're really desperate, you can have 6. But 7, you have a problem. Why 5? Well, because open, high, low, close, and volume. I mean, there is not a lot of data you're looking into. And massaging the data 10 different ways doesn't really help. I will be showing you my indicators. And this is what I use. I use a pair of moving averages. I use envelopes, MACD, and force index. I use 4, and that's enough. for me. Now, you don't have to use the same indicators, and you're very welcome to use different ones. But my point to you is, don't overdo it. Choose a few and stick to them. So what we will do in the next few minutes, I will review my favorite indicators with you. Please keep in mind, these are building blocks from which we will build a trading system. None of these indicators is a trading system. You cannot win in the markets with one indicator, cannot. Right? I said to you earlier that every single dot, every single price dot on this chart is a snapshot, a photograph, consensus, consensus, consensus. And that consensus keeps changing. And of course, a price bar connects the high of the time period with the low of the time period, opening price, closing price. If you like candlesticks, candles are fatter than bar charts, and the area between the open and the close is fat, and it's going to be white if it closed up and black if it closed below where it opened. So in any case, here's the history of this wonderful Google stock, and here is a moving average. What's a moving average? Well, a moving average is like a composite photograph. We take a picture of Mr. Google every day at the close, and we take last 22 pictures to a photo lab, telescope them into one photo, and now we have a composite photo of Mr. Google. Now, every day we're going to be updating that photo, and as we update it, the moving average line emerges. So a moving average line is a composite photograph of the market. If it's a short moving average, it's a short-term composite. If it's a long-term moving average, it's a longer-term composite. This moving average gives us two key messages. Message one, what's the slope? You know, this eternal dilemma. What do I do at the right edge of the screen? Is the trend still up, or is the trend now down? And I'll say, well, here Mr. Google was getting more depressed, and here Mr. Google becomes happier. So the trend of the moving average is up. And that's what I use to identify the trend of the market. And by the way, I use only exponential moving averages because simple moving average responds to each price twice, when price comes in and when it's dropped off at the tail end. And exponential moving average only reacts to incoming prices. Now, if you're using a 200-day moving average, it doesn't really matter one day, but if you're using a 10-period, 20-period moving average exponential, it has to be. So that's message one. Mr. Google is getting happy, so we're going to have to look at this market for buying opportunities. Message number two, the distance from price to the EMA. You can see how prices run away from the EMA and come back, run away, come back, run away, come back, run away, come back, run away, and coming back here. So where do you think is it better to buy? When they are far away from the moving average, or near the moving average, or below the moving average? Now we have two moving averages here. And here comes the key on which my entire approach to trading is based, whether it's long-term trading or short-term day trading. All my trading is based on this thing. We have two moving averages. One is fast, one is slow. I call the area between those two moving averages the value zone. There is a difference between price and value. You decide to buy a shirt. You wait until you get a circular from a department store which says the shirts that look very nice to you are 40% off. And so you go and you buy them because you figure that the price of the shirt is below value. Option B. You're going to this workshop, to this conference, and you stop by for a little breakfast, and you spill a container of cranberry juice on yourself. And you really don't want to go to the workshop dressed like that, and plus it's wet and it feels uncomfortable. You walk into the store to buy a shirt. The only shorts they have are $75 shorts. Well, you buy it, right? Because you have no flexibility. You're not, you need it now. So what is the value of that short? Is it $75? Is it $40? Is it $60? Right? So a fundamental analyst will look at a company and analyze its balance sheet and earnings and inventory, et cetera, et cetera, et cetera. And the technical analyst will look at a chart and say, well, this is what all the buying and selling is being done. This purple line is short-term consensus. This orange line is a long-term consensus of value. And so value lives somewhere in the zone between those two moving averages. And now you ask yourself this question: am I going to be a value trader or a momentum trader? If you're a momentum trader, you're going to be buying these things when they explode in a rally. If you're a value trader, you say, well, the trend is up, moving average is rising, let me buy it when it pulls back into the value zone. This is the key, this is the principle. I want to buy at or below value. So this is my first tool, a pair of moving averages, define the value zone. It really creates a whole new sense of structure for the charts. You can look at any chart and ask yourself, is it trading above or below value? We were looking at the DAX. So where is the DAX trading now? Is it above or below value? It's clearly above value. It's way above value. And it's about as high above value as it ever gets. Tells you something, right? Not to get too happy and too excited. DAX is over 10,000. That's a psychologically important number. What about during this kangaroo tail? Was DAX above or below value? It was way below value, right? We go to the chart of S&P. Look at this wonderful bull market of the last couple of years. Now, this is a weekly chart, so everybody presents 1 week. And you can see how every few weeks there is a panic attack. And when people panic, they sell off S&P value, 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 kangaroo tail, by the way, value, another kangaroo tail, value, value, big panic, way below value. But you see this pattern, right? When I see something like this, for me, it provides a sense of certain peacefulness. I know that I don't have to be anxious about missing the train. This train makes stops every few months. So this is the concept of a pair of moving averages, identifying the value zone. Tool number 2, envelopes. There was a mathematician, Benoit Mandelbrot. He died a few years ago. He was one of the more prominent mathematicians of the century. He was hired at one point by the Egyptian government to model prices of cotton. So Professor Mandelbrot studied them for the longest time, wrote a paper which earned him all kinds of academic awards, and the conclusion was this: hold on to your chairs. Prices oscillate above and below value. There are very few facts in financial markets. There, I think so, maybe, makes sense to me, but this is a fact. Prices oscillate above and below value. Well, if prices oscillate above and below value, and we can define value, I think we did. Now we need to define the swing of those oscillations. And if we can figure out how far they swing from value, we can trade against deviations and for return to normalcy. I do it with envelopes or channels. I draw my channels parallel to the slow moving average. And I draw them in such a way that they contain approximately 95% of all prices. So basically 2 standard deviations. In TradeStation, I have a tool called Auto Envelope. In stock charts, you can use Keltner channels. They work very well. And it doesn't really matter exactly what you're using as long as you're consistent with that. The difficult one is EMA envelopes, because they use certain percentage of price for the envelope, and that percentage changes. For example, for weekly charts, you need double the percentage than for dailies. So you're constantly going to be typing numbers, but calculated channels will do the job. So setting an envelope is like trying on a shirt. You want a shirt that goes from button to button without letter O, and that only your wrists and your neck stick out. And so a good envelope hugs prices. Warren Buffett is fond of saying that when you buy a stock, you become a partner with a manic depressive fellow he calls Mr. Market. He says the only good thing about Mr. Market, he wants to buy you out every day, and also he wants to sell you his shares. And he says most of the time you should ignore him because he is crazy by definition. But every once in a while, says Buffett, Mr. Market becomes so depressed that he offers you his share for a song, and that's when you should buy. At other times, Mr. Market becomes so manic that he offers a crazy price for your shares, and that's when you should sell. How do you identify depressed or manic? Well, I do it with channels. Here Mr. Market becomes manic, and here Mr. Market becomes depressed. You know, they say a neurotic builds castles in the clouds, a psychotic lives in those castles, and a psychiatrist is the fellow who collects the rent. Let's swing to our charts for a minute. Here's the chart of the S&P. What's the state of Mr. Market according to this chart? So right now, Mr. Market is way outside of the envelope. He is high as a kite, flying. Bulls are in charge, optimism is up, prices above upper channel line. This is a dangerous state of mania. A question that often comes up, what about Bollinger Bands? Well, Bollinger Bands are good for only one type of trading, options. Because Bollinger Bands, as you can see on this chart, they're tremendously volatile. They go far away from the moving average and far below and far above. Volatility determines option pricing. And so that's where Bollinger Bands make sense with options, but not with stocks, not with futures, not with indices. Okay, tool number 3. This gentleman, Gerald Appel, invented an indicator called MACD, Moving Average Conversions Diversions. Years ago, he invented this indicator, MACD lines. MACD is a combination of 3 moving averages. But you have 2 lines, a fast line and a slow line. And Appel was looking for their crossovers, but that's ancient history. In the 1970s, when the first technical analysis software became available, they began calculating the difference between MACD lines, and at that point, developed an indicator called MACD histogram. And MACD histogram is the difference between the 2 MACD lines. So the fast line represents short-term market consensus. Long-term line, long-term market consensus. When the fast line rises above the slow line, it shows that the market is more bullish in the short term than it's been. And so MACD histogram rises. Because it constantly measures the spread between short-term and long-term consensus, I say it measures the power of bulls and bears. Here, bulls are coming in, bulls retreated, bears came back in, and here, bulls come back. And you can see how this Google is making higher and higher highs, and bulls are becoming weaker and weaker and weaker. To me, this is like taking an X-ray of the structure of the markets below the surface. So, rising MACD histogram, bulls in charge, falling MACD histogram, bears in charge. The slope of MACD histogram is sort of a garden variety signal. You can take like for example here at the end, Mr. Bear is getting stronger. This is a garden variety signal that occurs at every bar. But a really major signal occurs not often, quite infrequently, and that signal is this, a divergence. Here is a chart, a bullish trend and the power of bulls. Bears come in and break through the 0 line. The stock rallies to a new record high, and this is the power of bulls. I mean, this is what I trade. This is what I look for in terms of trading. But just look at this, new high in price and the pattern of MACD histogram. Here, this Comcast drops, MACD histogram establishes a new low, maximum power of bears. This is still part of the same low. It's not a divergence because there was never any crossover to the upside. Here's a crossover to the upside. I call it breaking the back of the bear. And now MACD histogram sinks again. Mr. Bear here and Mr. Bear here. Lower prices, more shallow bottom. Bullish divergence. Buy, 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 buy. Zero line must be crossed between two tops over no divergence. This is not a divergence, A, but ABC is a divergence. Right? And here's something that came from Kerry Laverne, from my partner in Spike Trade. For years he's been calling himself a data junkie, which he is. He did extensive research, and he showed that the distance between the two tops or bottoms should be 20 to 50 bars, and the smaller the better. In other words, here the bottom ends 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Very short distance, very powerful stuff. With the distance here, the shorter the distance between two tops and bottoms, the more powerful the divergence. If you have one top here, the other top in the middle of the chart, it's forget about it. So 20 to 50 is the distance, and also the second top or bottom has to be less than half the height of the first one. The histogram has to be half the height at the second top or second bottom. Half the height or half the depth. Yes?
Does a divergence on one time frame matter more to you than on another time frame? A weekly divergence versus a daily divergence on the same security,
yes.
obviously.
Absolutely. The bigger the time frame, the more meaningful it is. A divergence on a weekly time frame is much more meaningful than on a daily time frame, is much more meaningful than on an hourly time frame, is hugely more meaningful than on a 10-minute time frame. The bigger the time frame, the more important. Tool number 4 is volume. Joe Granville famously said, volume is the steam that makes the choo-choo go. When I look at volume here on this chart, it doesn't speak to me. Volume was high here, it declined going into the bottom, supposedly a good thing. But you know, I'm looking at these bars and I start squinting. The volume bars alone don't speak to me. So I invented an indicator for measuring volume, and we'll deal with this in a few minutes. So these are the 4 tools I use: moving averages, envelopes, MACD, and the fourth one, force index. We'll be with it in a second. Chapter 7, trading systems. Impulse system, a censorship system. You need self-control in the markets more than anywhere else. It's important, if we don't do things ourselves, to impose a structure on ourselves which will tell us what is okay and what is not okay to do. And for me, that structure is the impulse system, is the censorship system. I'm sure you've noticed that some bars are green, some bars are blue, and some bars are red. What does it mean? What does it mean that the impulse system is green? Well, there are 3 colors, and these colors are based on 2 parameters: the fast moving average and the slope of a MACD histogram. So what is the fast moving average doing here? It's rising, right? What is the MACD histogram doing here? It's rising, and that's why the bar is green. If we go, let's say, to Amazon, what's the slope of the fast moving average? It's down. What's the slope of a MACD histogram? It's down, so the bar is red. Every move can be described in terms of inertia and power. Inertia is the slope of the moving average. Power is the slope of a MACD histogram. If both are rising, the bar is green. If both are declining, the bar is red. If they go opposite each other, the bar is blue, neutral. The impulse system catches every trend. There is no such thing as a trend not caught by the system. But you get killed in the transitional zones. Red, blue, green, red, blue, green, red. the impulse system kills you in transitional zones. This is not a trading system. It's a censorship system. It doesn't tell me what to do, it tells me what not to do. So if both the EMA and the MACD are rising, the impulse is green, I'm prohibited from shorting. If both EMA and the MACD are falling, the impulse is red, I am not allowed to buy. If I want to buy DDD, high-flying stock that fell from $100 to almost $30 a share, I look at the weekly chart, and the weekly chart is very nice and bottomy. I'm allowed to buy. I look at the daily chart, and the daily is red. And I'm looking at it every morning. And the chart says, Alex, sit on your hands. And so I never bought it last week. Now I have to decide whether I want to buy it next week, perhaps. But you see what I mean? So the impulse system is the censorship system which tracks two parameters of the market, the slope of the moving average and the slope of a MACD histogram. What you can see here very quickly is an entry into a trade. The weekly chart. This stock happens to be Eli Lilly, is climbing, 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 green, 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 and here at the right edge it's blue. Blue means you're no longer prohibited from selling it short. Right? The green is gone. The signal is not given by color. The signal is given by the disappearance of color. It stopped being green. We go to the daily chart, and you can see how the daily goes from green to blue, and now it's in full swing down to red. A bearish divergence on the daily chart really sends the stock spinning. I'm always thinking which to discuss first, the triple screen or the impulse system. So today I did the impulse system, the censorship. But let me actually come now to the system that I trade. And that's the triple screen trading system. The decision to trade needs to be atomized. Not itemized, as somebody transcribed it, but atomized, like molecules go down into atoms. You shouldn't say, oh, it looks kind of good, or it looks kind of bad. You should say, what are the parameters that you're going to trade now? We'll get to the exact planning later. But one thing which has to be atomized is this, strategic and tactical decision. Strategic decision, I'm a bull, or I'm a bear, or I don't know what this thing is doing, I'm moving on to the next one. And then a tactical decision, how do I implement what the weekly chart told me? Here is the sequence. You choose your favorite time frame, and you're not allowed to look at the chart. So if your favorite chart is daily, you're not allowed to look at it. You go to the chart one order of magnitude longer, to the weekly chart. And then on the weekly chart, you make a decision. Are you a bull or are you a bear? You know, so many people that just go closer, closer, closer to the screen, and now you can get live data free, right? So let's see what the 5-minute chart is doing. Instead of going into the screen, push away from it. Take a bird's eye view, the weekly chart. Are you a bull, are you a bear? Then you go down to the daily chart, and that's where you look for your entry and exit points. Entry point, target, and stop. Here it's all spelled out line by line. And so here are the rules. Strategic decision on the long-term chart. Tactical decision on your own time frame. So if you like the daily chart, you don't look at it until you review the weekly first. And so once you made a trading decision, check that trading decision against the weekly chart. Does the impulse system allow you to trade, or is it too early? So triple screen trading system, S&P. Well, first, what I always like to do with every chart, I want to compress that chart and take a look at a very long-term history, multi-year history. And by the way, we spoke about divergences. This was the divergence at the top of the 2007 bull market. Prices went to a new high, a little dark, MACD lines gave a major divergence. MACD histogram made a slight divergence. Another major divergence occurred here. Another major divergence occurred here in this area. So you can see how the S&P collapsed to a new low in 2009. This was the bottom of 2008. Depths of a MACD histogram, pulled back to value, and a second break. Look at this fantastic bullish divergence. I mean, it just jumps at you from the screen and grabs you by the face. And that was the beginning of this great bull market. Well, this bull market has now been going for 5 years, much longer than average. And here we are at the right edge of the screen. What do we see? Prices are above the upper channel line. The impulse system is green. And I hope you can see it, but if you cannot see it, no big deal, because you look at the moving average, rising. You look at a MACD histogram, rising. So everything is in gear to the upside. Mr. Bull is in charge. I am bearish with steam coming out of my ears, but this chart says you're not allowed to sell short. I look at by the way, I look at force index and I see how it cannot pull up to the upper channel line. It's weak. Bearish, bearish, bearish. And what does the green impulse system says to me? Not allowed to sell short, but I'm allowed to look, right? I'm allowed to plan. So we go to the daily chart, and what do we see here? Well, I want to show you there was a fantastic pattern here, which I am happy to say I traded. My friend Kerry and I were running a live class that day, and speak about timing. This was September. Okay, next Monday. So this is how the market closed on Friday, that previous time. We have an upside breakout, potentially a false breakout. We have a peak A of a MACD histogram. We have break B, the back of Mr. Bull gets broken. And at the right edge of the screen, a MACD histogram is rising, right? And the color of the impulse system is green, not allowed to sell short. That was Friday. What a difference a day makes. Monday, it opens lower. The color early in the day changes to blue. By the end of the day, it was red. And MACD histogram ticks down. So this was peak A of a divergence, and this was peak C of a divergence, ABC. Power of bulls, breaking the back of the bulls, and here Mr. Bull came back. And that's what he delivered us, that's all. And I sold short, right there in front of the group, put out over $250,000 worth of shorts. And they just opened up and went down and down and down. In any case, so that was history. Always nice to look at the past. Let's take a look at the present. This tremendous rally goes on, and we have the power of bulls. Peak A. There is a break, and this break breaks the back of the bull. B, sort of ABC pattern. And now this was Friday. On Friday, the impulse system closed green. Rising MACD histogram, rising fast moving average. And to me, this thing is just, it's standing on very thin ice. Bearish as bearish can be. Not allowed to sell short, right? Not allowed to sell short. Fortunately, have an indicator that will tell me at what level I am allowed to sell short. Now, remember, the color of the impulse system depends on the slope of a MACD histogram and the moving average. So if I can figure out at what number a MACD histogram will tick down, that will be the level at which point handcuffs are off. So S&Ps went out on Friday at 2075, and this dot tells me that if the S&Ps trade below 2076 and a half, the color will change to blue. So basically, if the S&Ps do not improve their Friday's performance by a point and a half, handcuffs are off on the daily chart. Let's take a look at the weekly. On the weekly, handcuffs will be off at 2080 and a half. So basically, as long as the S&Ps do not trade above 2076 and a half, I'll be legal to sell short. Does it work every time 100%? No. Does it work majority of times? Yes. And that's how I will be trading this coming Monday. Let me say a few words about ETFs. I hate them. Now, there are some ETFs which are okay. Spider is okay. Big, huge ETFs. So this is small caps ETF. What do I see on this chart? Before you say, I am bullish, I am bearish, describe what you see. When you keep a diary of your trades, which I urge you to do, put out a chart and write on the chart, or just mark it with circles or with arrows. What do you see there? It's describe before you start concluding. So the first thing that jumps in my eye on this chart is that force index gave us a sell signal here. Right? You see how during this wonderful run up, force index went outside of the envelope and it now sank back in. So we have a sell signal from force index. It's not a precision timing signal, but it's a useful signal. We see that prices have basically hit a high on October 31st. That's the weekly chart. And ever since then, they basically stayed flat. This was the peak. This is the peak at pretty much the same height. So we have prices are above value, approximately halfway to the manic zone. We have a sell signal from force index. And I'm bearish on the market. So I would say this is not like, this chart doesn't jump at me and grab me like that, but balancing, it looks toppy. It looks toppy. The impulse system at the right edge is green. MACD histogram is rising, EMA is rising. And the indicator says that it will turn blue below 117.85. 117.85. It went out at 117.16. So basically, if it doesn't go up from Friday, it will take handcuffs off of us. So the weekly says basically, if it stays flat, you can trade it. We go to the daily chart. The daily looks much more interesting, much more interesting. And by the way, I used to tie myself in knots looking for situations where the weekly and the daily looked great. And I finally said, don't overdo it. You're using 2 time frames. One has to look great, and another has to be okay. Has to be all right. Tremendous, it just improved my life a lot after I said that. And it doesn't matter whether it's the weekly or the daily. So the weekly was okay. The daily is a whole other matter. We see this tremendous upsurge giving us peak A. We see a breakout, actually repeated breakouts, and they once, twice, and now as of Friday, a third breakout going on. But those breakouts don't have a very good history. We see breaking the back of the bull. And we see the quality of rallies after that. And there's a rally at the right edge of the screen. There is a type of a divergence. I didn't want to get into it today, but I'll have to. It's called missing right shoulder divergence. This is left shoulder, break. This is right shoulder. And it looks like another shoulder will come where it will not even reach zero. So this thing looks very top heavy to me. At what level will the colors change? Below 117.06, it will stop being green. So it closed out at 117.69. It has to go down basically 63 cents to start being green. If you asked me this type of question years ago, 10 years ago, I would have stopped where I stopped now, and I would have considered my job done, accomplished. I analyzed a market in multiple time frames, and I gave you levels at which the stock can be traded. There is a whole other huge, and that's what a mid-level trader does. That's where the beginner doesn't know this stuff. The mid-level trader knows this stuff and stops after he's done it. But there is a third layer, third level, and that's where real serious traders live. And that's risk management. So the system says we will be legal to trade below 117.06. So let's say at 117.05, we're going to sell this puppy short. Every trade requires three numbers: entry, target, and stop. And if you don't have those numbers, it's not a trade, it's a gamble. So what's our target for this trade? I like going back to the weekly to set up a target. And as I look at the past, I see that every once in a while this market panics, goes down to its value zone. The slow yellow line on the weekly chart is at 114.14. So I would say my target would be at least 114 for the stock. Prices swing above and below value. Well, on the weekly chart, they're above value. And I think it's reasonable to suggest that they may swing back to value. So we're shorting at 117.05. We're with a target at approximately 114, right? So we're looking to make about $3.05. Real men don't use stops, which is why I want to trade like a woman. So for a stop, we go back to the daily chart. What would be the logical stop? Well, I can tell you what an illogical stop would be. If you go to the highest high, which is 118.78, I'll bet you dollars to donuts that there is a crowd of stops at 118.79, 1 cent above the high. Let's not do it. Let's not go with the crowd. I would say maybe the high of Friday would make sense. I am assuming that we get a signal on Monday. If not, we'll have to rethink our stop strategy. But the high on Friday was 117.98. Well, if I was putting a stop, I would not put it at 117.89 because people, myself included, are generally lazy. And if the high is 117.98, I'll bet you there'll be stops at 118. Right? So I want to put my stop a little bit further than that. So maybe 118.05. This way we risk exactly $1. So we're risking $1, trying to make $3. That's not a bad ratio. It's not like take my breath away ratio, which occasionally you get, but it's a workman-like ratio. The plan for Monday, just for 1 day ahead, shorting at 117.05, protecting at 118.05, with a target at approximately 114. We established the numbers. The next question is, how many shares we're going to buy? That is the question we're going to have to answer. How many shares do I buy? And please don't tell me, oh, I made money on my last trade, so I'm going to trade double, or oh, I lost money on my last trade, so I'm going to trade nothing. I'm just going to watch it. Because that's not the way to do it. You have to trade signals and not your latest trade. Okay? I think this was as good an illustration of triple screen trading system that I could deliver to you. We analyzed this one ticker that you brought up and created a plan for Monday. So first of all, it has to go a little down in order for us, right? If it continues to go up, your idea to sell it short stays in effect, but the plan we created will have to be redone because those crossover points will change after one day. And then, of course, we have to look at the pattern. We'll have to look at the pattern of Monday to see where our stops will go, et cetera, et cetera, et cetera. But this is an example. Triple screen while controlled in the background by the impulse system. Risk management. Most traders get killed by fish. 2 causes of trader mortality. You know those guys. Right? On the left, you see a shark. You put in a trade, you lose 40% of your account. And that trade, it's like a swimmer or a surfer who lost an arm or a leg. Basically, their swimming, surfing career is finished. Fortunately, in trading, it's not physical damage, so you can refund your account, fund your account again, I should say, and be back in business. But that particular account is dead after suffering a shark bite. The fish on the right is piranha. It's a tropical river fish from South America. Nasty, but not deadly by itself, because it's only about as big as 2 hands together. But the trouble with piranhas, they attack in packs, and a bull walks into the water, gets bitten by a piranha, takes a small loss, but he is a man. He is tougher than that. He can wait it out, so he stays in the water. You know, female would have gotten out of the water much quicker, but he is tough, so he stays. And he doubles up and he gets eaten alive by the piranhas. 5 minutes later, only bones floating downhill. So piranha bites are a series of nasty losses, none of which is deadly, but together they add up to a deadly outcome. So we'll talk about 2 causes of trader mortality, the role of a manager, and money management rules. So what do we do with this fish business? We have rules. We have rules. Crossing the street, first you look left, then you look right. I mean, there are rules which are clear as a day. There are certain things which I just insist on you having. And one of them is this, the 2% rule. Never risk more than 2% of your account equity in a single trade. How does it work? Well, let's come back to that IWM trade. We're buying at 114 something. Remind me the numbers.
117.05.
We're shorting at 117.05 and we're protecting at 118.05, right? A dollar risk. So give me a number for a trading account. $50,000. $50,000 is a wonderful size for a new trader account. It allows you to diversify, but it's not too crazy big. You want to have a good size account, and then you add to that account when you earn an increase. So if you're trading well, you have this reserve capital, you add reserve capital. But if you're not trading well, if you're losing money on $80,000, why would you want to lose money on $120,000? So back to the trade, IWM. So we're shorting at 117.05. We're protecting at 118.05. We're risking $1. And we have a $50,000 account. So according to the 2% rule, how much are we allowed to risk on this trade? We can risk $1,000. Does it include commissions and slippage and all of that? Complete, okay. So how many shares can we buy then in that case? 1,000 shares. 1,000 shares of $115,000 or sell short, actually. We're short in 14. We're going to be pretty heavily margined on that trade, yeah? Let's do it with options instead. No. The 2% limit is really an extreme limit to go, that you cannot go beyond. But you don't have to go to that limit. Why don't we do 200 shares? Or 300 shares? Okay. That should keep us busy enough of the streets. And also what it will do, trading a smaller size will reduce our level of pressure, our level of tension that we feel. Trading is an old man's game, now increasingly a woman's. No rush, no rush. Get good first, and then, if you know how to trade 200 shares, you can trade 1,000 shares later. So trade small, trade small. In any case, I have this picture. I call it the iron triangle of risk control. ABC. A is how much you plan to risk on this trade. I mean, if you have $50,000, you probably should not be risking 1,000. It's an extreme number. If you have a trade that just has steam coming out of your ears, maybe that. Otherwise, make it a smaller trade. B is the distance from your entry to your stop in dollars. In that IWM trade, our distance is $1. So we're allowed to risk 1,000, but let's say we'll only risk $200. We divide $200 by $2, and we get a number of shares we can buy. 200 shares of IWM. Some years ago, I was teaching a class in school where all my kids were, from which all my kids graduated. Was teaching a class called Money and Trading. And I opened a $40,000 account to trade in that class. So I spent several months meeting with the kids, giving them basically what I'm doing here today. And then the rest of the year, we traded my money. A kid comes in and says, brings a stock he wants to buy, $18, where's your stop? $16.50. And I gave the kids a 1% rule. The deal was this: if the group loses money, it's my problem, it's my loss. If the group makes money, I'll give half the profit to school, half the profit will be divided between class members. So here's a question for you. Buy at 18, protect at 16.50. Your maximum risk on a $40,000 account is $400. How many shares are we allowed to buy? Quick. Huh? About 250. Right? This is the iron triangle of risk control. What is the concept of available risk? So many people approach buying and selling stocks from a completely wrong angle. I have $50,000 in my account, and this stock is $90 a share, and I don't want to risk more than 20% of my account. How many shares can I buy? And people are completely serious when they say this absolutely nonsensical stuff. To me, you don't operate from this, I mean, completely superficial and really irrelevant numbers. You operate with what your risk is. You're a trader. You measure risk. If you say, I have a $40,000 account and I allow myself 1% risk, well, you have available risk of $400 a trade. That's page 1. Page 2, the 6% rule. What happens if you have one bad trade after another? You know, maybe your system stopped working. Maybe you have some personal issues and you're just out of gear with the markets. When will you stop? When will you get out of that water with piranhas? 6%. If you experience a 6% drawdown, out of the water for the rest of the month. In that case, your available risk, if you started the month with $50,000 and you allow yourself 6% risk, it means if your equity slips down to 47, out you go. So when you're looking at a trade, your first question is, do I have any available risk? I have so many open trades. This is my open risk on existing positions. This is how much I lost so far this month. Do I have any more available risk?
The 6% is only a drawdown, it's not a gain.
Right, gain, you can gain all you want. Oh, by all means, send me a postcard. worry about losses. Gains will take care of themselves. You know, and it's just like in life in general. Whenever I am faced with a difficult situation of any nature, I always ask myself, what is the worst possible outcome? People hate thinking, I hope everything works out fine. Yeah, me too. But what is the worst possible outcome of what's happening just now? Say you have an argument with a friend, or somebody owes you money and they're suddenly unavailable by phone, or you hope for a promotion in a job and things are shaky. Instead of just being nervous and hoping, always ask yourself, what is the worst? Spin that, take today's situation and spin it to its logical conclusion. What is the worst possible outcome? Well, now you're in control. You know what's the worst possible outcome, so whatever happens is going to be better. And you know that the worst is not so bad after all. Classical chart analysis. Classical charting began, I mean, that's how technical analysis began, and it began a long time ago with a man named Charles Dow, who was editor and owner of a little broadsheet that went out called the Wall Street Journal. He came up with this concept, averages discount everything, meaning everything is reflected in prices. He never wrote a book, but he wrote many editorials, when after he died, the magazine was bought by the people by the family who eventually sold it to Rupert Murdoch a few years ago. They owned it, a family from Boston that owned it for decades, and they hired this man named William Hamilton, who did write a book, and it was really the first book on technical analysis. So the revolutionary concept was that prices reflect the sum total of knowledge about the market. Smart money and dumb money, slow money and fast money, everything is in prices. And if you only follow prices, you can tell which way the market is going. You don't have to read balance sheets. And out of it grew this whole classical technical analysis, trend lines, heads and shoulders, double tops, double bottoms, rectangles, etc., etc., etc. To me, it's absolutely, totally, and completely dated. Dated because when you look at a chart and you start doing things like, is this reverse head and shoulders? Oh, is this a trend line? Or no, this is a trend line. Oh, is this a trend line? Or is this you know, it's so subjective. And I have this terrible problem, my fingers shake when I trade. And when I'm bullish, they shake up when I try to draw a trend line. And when I'm bearish, they shake down. So to me, this classical charting is so wildly subjective. It's dangerous. The market doesn't know diagonals. I mean, if you put on a trend line like that, and now you change the formatting of this chart, the trend lines will have to change. There are only two things I really trust and use in classical charting, and use all the time. I think horizontal lines matter. Horizontal support and resistance matter. They matter because people remember where prices bottomed out before. And when prices come back to that level, they're prone to buy. Same thing with the tops. Another thing I believe in a lot are false breakouts. So horizontal lines and breakouts. Here's a chart of Tesla. And it's a weekly chart. It covers just about 2 years of trading. Here is a weekly chart that covers all of history of Tesla, which is about 4 years old. So some brilliant genius bought it at $20. And of course, it's very tempting to think that we can hold it from 20 to 200. The problem with this thinking is this, that here Tesla reached 194, and then over the course of many weeks, it slid down to 117. So if you have 1,000 shares of Tesla, and it's sliding from 197 to 117, $80 down, are you still holding through the drawdown? I highly doubt it. But that's the problem with long-term holding, and we'll talk about it again later. But let's get to what I mean by a false breakout. So Tesla establishes this peak, so it breaks out, continuous rally, pulls back, seems to break below the breakout line, starts on a new rally, and look what happens. It breaks out to a new high, spends 1 week above it, second week above it, and sinks back on the third week. And this, to me, is where the false upside breakout is completed. Tesla tried to break out to a new high. It broke out to a new high. And now, during this week, it identifies it as a false upside breakout. And that, to me, is a very, very valid concept. Right? It tried and it failed. Well, what it's likely to do next after it failed there? Try it again? Probably not. It's more likely to continue in the opposite direction. So this is a pattern. These are two patterns I really look at the markets for: support, resistance, and false breakouts. And my favorite form of a false breakout is called a kangaroo tail, where there are two fairly narrow bars bracketing a very tall bar. And kangaroo tail or a finger, the market throws out this long line, tries that price level, and then it says, nah, don't like it, and goes the other way. Here's the chart, Canadian dollar. Look at the kangaroo tail, look at the false downside breakout, look at the false upside breakout. Look at this, 2008, Canadian dollar crashes and burns, rallies, and then in March of 2009 drops to a slightly lower low. Spends no time there at all, false downside breakout. And a beautiful rally begins. In 2010, that rally ends the same way. Top, pullback, breakout to a new high, and failure. You can't miss them. I mean, they jump at you from the screen. You don't have to squint. If you have to ask yourself, is there a false breakout? There is none. Because when there is, you can't miss it. Let's get a current chart. What do we see? The chart of the Canadian dollar. The low in April was 88.07. You see false breakout and the rally begins. Right? Now, this low was 87.12, and low last week, 87.12 again. I actually don't like that. I want to see a break of the previous low. The fact that the low is holding, it's too neat to be true. But just as an example of a pattern I pay a lot of attention to. So support and resistance, they make logical sense. People remember prices. False breakouts make sense. The bull tried and failed, or bears tried and failed. And of course, my favorite unmissable type of a false break is this kangaroo tail. And you can see lots of them on the chart. Long bar, and very often trends reverse at those bars. Facebook, daily chart. Sort of kangaroo tail, reversal, false upside breakout. And to me, these are patterns that once you see them, you don't have to squint ever again to find them. False breakouts, kangaroo tails. We analyze market psychology. We try to figure out how this crowd is shifting, how this crowd is moving. And it shows that the crowd was very bullish. And by the end of this bar, that bullishness failed. Well, let's sell short. Markets go both ways. They go up and they go down, and they spend 2/3 of the time going up, 1/3 of the time going down. Now, some people don't like shorting, and that's perfectly fine, but you got to sell short to say I don't like shorting. Wait, yes, please.
The most recent lows in the market in October, was that a kangaroo tail?
Let's, in the market, you mean like in the stock
The
market?
SPY or?
Let's take a look. The weekly chart of the S&P. This was one substantial kangaroo, wouldn't you say? It wasn't a little kangaroo. And at the time of that kangaroo tail, there was a cluster of other signals, which we'll discuss. But it's a very good call on your part that it was most definitely a kangaroo tail. And these kangaroo tails, they tend to move prices for a while. So once you see that kangaroo tail, you have some, the move is not over the day after the kangaroo tail. Furthermore, I'm starting, with this chart, I'd like to introduce this concept about which we will talk in detail later, that markets have to be analyzed in more than one time frame. Strategic decision on the big time frame, tactical decision on a shorter time frame. So this kangaroo tail we're looking at here is on the weekly chart, right? Well, now we have a field day ahead of us. Let's switch to the daily and look for buying opportunities. You see what I mean? Strategic and tactical. Strategic, kangaroo tail. Tactical, where to buy and where to sell.
Would you look at the DAX also for kangaroo tails there as well?
Let's take a look. I want to look at it on a weekly basis. There is not too much doubt about this animal, right? Yes, there is a kangaroo tail on it. The patterns I'm showing to you are universal because they reflect human behavior and how humans act, especially under stress. Markets provide plenty of stress. You know, people speak different languages, live differently, but whenever we get our fingers caught in the door, we'll scream the same way. You know, it doesn't matter whether you're in New York or in Hong Kong, and whether you had 2 or 22 years of schooling. You know, it's you know, civilization is just a thin veneer on the whole thing, and that's what comes out in the markets. And so these patterns, they work worldwide. I traded in Australia. I traded in Singapore. I traded in Russia. Obviously I trade in America all the time. I like trading only where I live because I don't want to go into a different time zone. When you trade, you try to pick other people's pockets, and they try to pick yours. And it's tough enough when you're awake, but when you're asleep, and they're picking your pockets. So that's why I look at the DAX once a week. But when you ask me, does this pattern work in DAX? Pull up the chart, of course it's going to work in it.
In terms of timing, though, I mean, we're looking in hindsight, right?
Hindsight is a wonderful time frame.
Right, but in real time, you're not going to see that kangaroo tail at the moment when
No.
it's going down. So
Well,
how does that work?
If you're a very, very serious professional trader, you will recognize it during that bar. If you visualize this trend, just imagine the DAX is cracking. Week, huge week down, and the second huge week down, right? So forget about what's on the right edge. Imagine this is the last bar, and it just looks horrible.
It might keep going down.
It keeps going down, and then it stops going down, and it starts pulling up towards the end. Well, it's confirmed as a kangaroo tail, not during this week, but during the next bar. You have to have front bar, during bar, and after bar. And it's the after bar that you have a very clear confirmation. If you're very, very good, you will start recognizing it earlier. You will probably switch from the weekly to the daily chart, etc., etc. But the complete classical pattern will not be finished until the bar after the kangaroo tail. Good morning, everyone, and welcome to this workshop. Very happy to see you here today. I know we will have an interesting and productive day ahead of us. What I intend to do today is go through the entire book very quickly, chapter by chapter. Along the way, I will toss a few tests at you. It's easy to fall into a trance, almost like driving on the highway. You hold the wheel and you look forward and you think you're driving, but you're not driving, you're just following the road. You have to be prepared for the unexpected. So tests. Also, I want us to spend a fair bit of time today looking at current markets. I'm sure that you have stocks you're interested in, commodities, currencies, whatever. So I would like us to review what you're interested in. So it will be a combination of theory and practice sort of practice at the right edge of the chart. So that's my plan for the day. I understand that most of you have read my books. Do we have anybody who hasn't read any of my books? We have a virgin in the room. A partial virgin, yeah. Well, I appreciate you coming here, because coming without having read a book, really a sense of trust, and I hope you're not disappointed. How I got myself into book writing. And by the way, if any of you ever decide to write a book, talk to me. I love this topic, and many of my friends have written books since then. I used to have a terrible writing inhibition. My background is in psychiatry. Whenever I had to submit a write-up of a case, I would just sit there tied into knots like that. Couldn't write. And then I figured out that it's like there were two persons in my head. There was a writer and there was an editor. So when I was writing, I was thinking, oh, I could say this better, I could say this differently, this should be done in a different way. So once I figured it out, I said, that's it. Writer writes, editor out of the room. So I just fling whatever I fling on the page. And then the first draft is done. And then the editor comes in and makes a book out of it. I began learning how to trade, gambling, I would say, in my 20s. And I really didn't know what I was doing, but I was reading all these books and indicators, psychology, GAN, back in those days, everything. And eventually things started settling down. And I began writing this book to write, basically I was writing it for myself the way I was several years before I wrote it. Everything organized and everything in order. I don't have to go to 50 different books, but everything in one place. And that's how my first book, Trading for a Living, came about. Became a big international bestseller. I never thought of success, I never thought of money, I wanted to write the best book possible. And that book is now over 20 years old. It was still a bestseller as early as this year. I finally agreed to my publisher's request to write a new book, to update it, the new Trading for a Living. And I thought it would be a quick project. 3 months was my time budget. Took 18 months and just completely major amount of work, and it became a completely different book. Today we'll go very quickly through the book. Successful trading is based on, I used to say, 3 M's. Mind, method, money. Mind is how your psychology is organized. Method is how do you decide what do I buy and what do I sell, and money is your risk management. Well, I think there's a 4th M, and that's management in terms of record keeping. The quality of your records ties it all together. Your technical analysis, your psychology, your risk management. You've got to keep records. You probably know I'm involved in running this group together with my friend and partner, Kerry Lavorne, Spike Trade. In Spike Trade, we have a weekly competition for the best pick of the week. And the guy who wins the best pick of the week writes a report, how I won my gold. So we have this group of elite traders who are competing for the best pick of the week. We have a guy who, since the beginning of this quarter, October, November, now the first week of December, won 5 golds. And he's being thrown out of the group at the end of this quarter. This is why. The black line is his equity curve. So he starts from 0 at the beginning of the quarter. And right now, at the right edge of the screen, he is down 15%. There are 13 competitors. There are 13 elite level traders. So there are 13 competitors, and the guy beats everybody half the time. If we go to the website, and this is Spike Trade website, then right at the front page is his report, how he traded last week, what indicators he used, and how he made 7.64% profit in 1 week. And he's being thrown out because his equity is here. So what's wrong with this picture? How come? There's no risk management. This loss which he suffered last week, he wants to win. So he's gaming the system. He buys a $5 stock. Right away, you know, the guy buys a cheap stock, so he's waiting for a big swing. Unfortunately, those cheap stocks, when they swing the opposite direction, they're just as bad the other way. So he is profitable early in the week, and on Friday, the stock is called to open lower. So he pulls his stop. He doesn't want to be hit on a stop. And the stock does open lower and continues to slide, and by the end of the day, he is down 20%. Right? So what is it? Lack of knowledge? Lack of understanding? It's lack of risk management. Lack of greed. I think I think it's arrogance more than greed, because he wants to be on top of the game. In any case, we'll spend a lot of time today talking about the method, and we'll spend a lot of time today talking about selecting stocks to trade and how to trade them, and where to enter, where to exit. But without risk management, it's absolutely useless. And then the final line, self-management, how do you do it? You have to keep records. You have to analyze for every trade what you did right and what you did wrong. We'll be talking about it. So this is our outline for today. Individual psychology, math psychology, classical chart analysis, computerized analysis, volume and time, general market indicator. In any case, I don't have to read the menu to you. General market indicators. There are two indicators I want to show you, and I very much want to encourage you to use them. At least one of them is publicly available and it's free. The second one I get from TradeStation, but I imagine it's available just as well on other programs. There is this wonderful website. I like it very much. The company is called barchart, barchart.com. They have very nice, very clean data. And every day I look at this page, which says current new highs, new lows. What I do here is this. There are three pairs of numbers I look at. 1 month's highs, 1 month's lows. So basically, I could spend an hour talking about the new high, new low index, which I believe is the best leading indicator of the stock market. Those of you who know Spike Trade know that every night we send out an updated chart of the new high, new low index with our commentary. Why? Because we consider the new high, new low index the most important leading indicator. Now, what's new highs and new lows? New highs are stocks that are making a new high for the year. They're the leaders in strengths. New lows are stocks that are making a new low for the year. They're the leaders in weakness. For example, if we look at Friday's data, 302 stocks made a new high for the year. 216 stocks made a new low for the year. So we have more leaders to the upside than to the downside. But the balance, the 86, we have 86 more new highs than new lows, is a ridiculous number. Because if we pull up a chart, we can see that on October 31st, there were 389 more new highs than new lows. Right? So the new high, new low index was 389. Now it's 86. And if we compress the data even more, we can see that earlier the new high, new low index was in the 600 range. and et cetera, et cetera, et cetera. So basically 86 is a very, very feeble number. We still have more bullish leadership than bearish, but that leadership is steadily becoming weaker and weaker, and I am waiting until these two numbers flip, when we have more new lows than new highs, which is we're very close to. And that's, I think, when the market will be ready to tip over and go. For somebody who is not an active follower of the market, what indicator should I follow? We'll say the 12 months new high, new low index. As long as it's positive, you're okay. Once it's negative, pull everything out. But in any case, I consider that the single most useful indicator, and I'm giving you this website. Just pay attention to this balance, especially on a 12 months basis between new highs and new lows, because that's the lever for the market. There are many other items to consider with the new high, new low index. Gary and I wrote an ebook, the new high, new low index. Another indicator, which I have in TradeStation, stocks above 50-day moving average. When a stock is above its 50-day moving average, it's obviously bullish. Right? It's outperforming itself. When it's below that moving average, it's obviously bearish, it's underperforming itself. And here is the indicator. If you look at the new high, new low index, this is the new high, new low index on the weekly chart. From a year ago, it's been going lower, 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 right? So the quality of bullish leadership is sinking. This is new high, new low on the daily chart. Since mid-October, the leadership is sinking. So count me a bear. But coming to this indicator, stocks above 50 moving average, they come near the upper line and turn down, they come near the lower line and turn up. So basically, when everything gets very, very happy, it gets worse, and when everything gets very depressed, it gets better. And so this indicator, this chart is updated through Friday. This is what we get from stocks above new high, above their moving average. And the message is, the market is beginning to sag. I think we have a test. It shows you 3 charts, and the question, what is the impulse color at the right edge? So 3 columns. First column, what color do you think it is? Green. I would say it's green because moving average is rising and the MACD histogram is rising. What color is this guy? Blue. It's red because the moving average is declining and the MACD histogram is declining. It doesn't matter that it's above 0, it's declining. What color is this? Blue. Why is it blue? Moving average is declining and MACD histogram is rising. Okay, so these are your answers. And here we come to volume and time. Force index links volume with price change. To me, this is the best way of tracing volume. Well, the formula is here. Let me show you the chart. Basically, the force index multiplies price change by volume. And there are 2 ways in which I follow it. Here's the subtrend, the same, this Google that we're chewing on. And the trend is up. And every once in a while, force index drops below 0. So the tide is up. Force index identifies a wave that hits against the tide and basically says, this is a good buying area. If you use a very long-term, if you use a long-term 13-bar moving average, it helps catch major trend reversals. Let me show you what I mean maybe in the current markets. Here is this chart of the S&P. And at the bottom is a 13-bar force index. It trades in an envelope, and every once in a while, it gets out of the envelope, and then it comes back in. Here, force index very slightly popped out of the channel, and on the next bar, it came back in. Here, came out of the channel, and on the next bar popped back in. It doesn't catch every bottom and every top. But when it does give you a signal, we better pay attention. You see, it shows when volume swings heavy outside of the extreme and comes back into the channel. Let's apply this to some stocks or commodities. Gold. Okay, so this is the weekly chart of gold. Here it came into, here was a buy signal, and here was another buy signal, and here was a sell signal. Strangely enough, this indicator works very well on the weekly charts and nothing on the dailies. So in gold, basically, there is no signals since it told us to sell gold in March. It wasn't a bad signal at all, but nothing much is happening.
GM.
Okay, GM. Take a look. Sell signal, not shabby. Another sell, and another sell. A buy signal, not shabby. Here I think here was a bad signal, very rare occasion, and here the signal came back again and off to the races, and nothing much since then. Potentially this was a signal. I mean, it doesn't happen at every top and at every bottom, but what this spike of weekly force index does, it shows some kind of extreme event, extreme volume that went too low or too high and choked up. Crowds do not maintain extreme for a very long time. You know, there is a riot, and eventually the riot runs down. And you go to the place where everything was a riot a week ago, and it looks absolutely peaceful. Emotional extremes are not sustainable by people or by crowds. As soon as force index starts returning into the envelope, it shows basically that the riot has broken. These to me are among the best long-term signals in technical analysis. They don't happen very often, but when you see them, better act. Let me pull up a few stocks. CMG, $660?
Was a Mexican food? I mean, really?
Well, that's not a bad sell signal, is it? And it's currently on a buy signal from here. 660. There's Chipotle across the avenue from where I live, and I've never been inside. I better go there.
And it's just been climbing. If you know, tighten up the time frames a little bit, it's just been unbelievable.
Well, this is the weekly chart. Yeah. In any case, let me take a look at something I'm interested in. Tesla. It's actually approaching the lower channel line, curiously enough. Google, approaching lower channel line. Amazon, midline. Yeah, so no signals, no signals there. And just for another view of force index, we go now to the daily chart. The trend is up. When force index goes below 0, that's generally the good time to buy. Time in the markets. I observe that markets move at the same time in different time frames. They move on the weekly charts and daily charts. They move on the hourly charts and 10-minute charts. And they can be moving in different directions. They can be rising on one and falling on another. So when we analyze markets, we should really pay attention to more than one time frame. All of those time frames are connected to each other by approximately a factor of 5. A monthly chart, where a bar represents 1 month, 4.5, approximately 5 weeks. A weekly bar has 5 days. A daily bar has 5 to 6 hours in the trading days, etc., etc., etc. So we can slice these things by a factor of 5. We have by now reviewed the indicators, including force index, which is based on volume, and time in the markets. So we're approaching our trading systems. But at this point, I'd like to take a bit of a pause and suggest we take a test. 4 questions. What is the trend? Of course, at the right edge of the screen, that's where it matters. Mark undervalued zones, mark fairly valued zones. And what do you recommend doing at the right edge of the screen? 1, what is the trend? 2, mark undervalued zones. 3, mark fairly valued zones. Your trading stance at the right edge. So I think that the trend is up here. The undervalued zones are obviously below both moving averages. There is one in July and another one in early August. The market is fairly valued inside the value zone. And at the right edge of the screen, I would be looking to buy. If I cannot be in front of the screen during the day, I might place an order probably down the middle of the value zone. Let's do puzzle number 2. Mark zones of mania and depression. So, how about this? Mania, 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 right? And I think there was just one depressive episode here. Puzzle 3. Identify the pattern at the right edge. So this is the pattern. We have top A of prices and top A of MACD histogram. So maximum power of bulls. B, breaking the back of the bull, and at the right edge, C, prices do everything right. They run outside of the channel, there is a small kangaroo tail, and the MACD histogram ticks down a bit. And if we now go forward, this is what happened next, was a bearish divergence, and a tremendous slide followed. After the workshop, and now let's look at anything I have missed. Any stocks you would like to look at, or yes?
Could you look at RHT as a short possible?
Okay. RHT. So notice, by the way, that before I do anything, I go to the weekly format, right? I will not allow myself to look at the daily chart because it'll prejudice my eye. So RHT traded between $65 and $10, and it's closer to the high than to the low. So this, is it expensive or cheap? First question. It's expensive, right? The previous high in August reached 62.69. The high 3 weeks ago went to 63.69. So there was a false upside breakout, very clearly. At the right edge of the screen, the weekly chart is blue. We're legal to sell short. Scrolling down, we look at MACD histogram. There is a nasty bearish divergence in this thing. The power of bulls at the previous stop, the break, and now the power of bulls, a massive bearish divergence. So strategically, I want to sell this thing short. And that's the end of the weekly chart. Strategic decision on the weekly. Going to the daily chart. Well. The daily chart is, ever since it's made that false, look at this reversal bar. Opens near the highs, hits a new record high, sinks all day, closes near the low, end of uptrend. At the right edge of the screen, it's slowly sinking. It's slowly sinking. It's now just about in the value zone. MACD histogram is low. And I would say, I like to sell short above value, but this is a completely legitimate short. Completely legitimate short. Not my preference, but a completely and totally legitimate short. So what numbers do we do? Let's say this moving average on Friday was at 61.83. We try to sell it short there, 61.84. What's the ATR? ATR equals $1 in this stock. If we short it at 61.80, let's say 61.80, we have to put a stop somewhere above $63. Oh, that's a lot. And the target, I would say target about 58. So we'll be looking to make close to $4 while risking $1.50. If I really wanted to sell short this stock, do you have access to live data, or you do it just purely end of day?
No, live data.
Okay, so I would put it on my A list. A list are stocks that I may trade today. B stocks are the stocks that I may trade later this week, and C stocks are stocks that I don't want to see until next week. And so this is an A list stock. I would love to look for a rally, like on a 25-minute chart, and see that rally choke up and sell short into that rally. So that I have these numbers that we have developed based off of weekly and daily, and they're not hugely attractive. And I would say, well, let me sit back and look for a rally and short into a rally. And then you ask yourself, well, what if a rally never comes? What if the bottom falls out on Monday? You want to, then you miss it. Or you put a small order below the market. Yes?
I was just wondering if that parallels Apple, that same move that you're looking at. Is there so intertwined, those two?
Weekly? There is no divergence on the weekly in Apple. Apple daily? Not very clear technical signals here. Yes, please.
How reaching long?
Let me suggest this. Force index is profoundly deeply below the channel on the weekly chart. You don't have to catch the absolute bottom, but you can go to a program like stockcharts.com, which includes this thing for free. It's a good price. And put a 13-week exponential force index on your chart. I would want to get some technical information before I bought it. Just to step up and buy it because it's a discount. Scared.
Ford.
Huh?
Ford.
All right. Again, going to the weekly first. Ford. Wake me up when it's over. Why? It's a relatively inexpensive. It's a relatively inexpensive stock with apparently great fundamentals, trading right at value, right in the value zone, and I look for differences between value and price. And here, value is flat, and price is flat, and price equals value. So I look at it and say, well, what am I going to do with it? Right? So markets are very chaotic, and chaos cannot be analyzed. Out of that chaos, occasionally a pattern emerges. And so that's what I do. I sit at the edge of this river, watching this shapeless flow, and every once in a while there is a vortex. And that's where I trade. But I would say the ratio between chaos and order is maybe 8-2, 4-1. So very often I'll look at a chart, someone will ask me about a chart. I say, haven't got a clue what to do. Although I want to point out to you, the latest signal that actually Force Index gave us was not a bad signal at all. When Ford got sold down and then reversed, before it got really strong, Force Index pulled back into the envelope. That to me is an amazing signal. It doesn't catch all tops and all bottoms, but man, does it make sense. It shows when bulls or bears become extreme and reverse. So if somebody held a gun to my head and said, Alex, you've got to trade this thing, I would say, well, the last signal was Buy, I would buy it, but phew, no guns here. I'm not touching this thing.
You said you're not touching the Ford there,
Yeah.
because it's right at the top of the...
Price is sitting right in the middle of the value zone, and moving averages are flat. So flat moving averages for a year. It's a stock with an established value, and it trades at value. Remember, I aim to make money when price is below value or price is above value. And here, everything is in gear. And someone like myself I have no business with this. I very much encourage you to join Spike Trade. That's a lot of fun and interesting picks. Read the book. And so I want to thank you once again for coming here. Thank you very much. Mass psychology of the markets. The general human tendency is that we huddle under stress. What do you think? What do you think? So is Tesla going up or is Tesla going down? Markets provide plenty of stress. And the tendency that we have, we look at what other people are saying. But the difference between the market and many other areas is that market is absolutely hostile. If you drive and accidentally swing into another lane, the guy who is driving behind you he may honk at you, but he'll hit the brakes because accidents are expensive for both parties. In the markets, you swing into your own lane, somebody will take your door off of your car together with your arm. So asking other people, what do I do, is probably not the best idea in trading. One of the worst things that traders do, they put in a trade, and let's say the guy buys Tesla, and now he goes on the internet to see what other people are saying about Tesla. Well, is that part of your trading system? I mean, you decided to buy when the moving average is up and prices are near the lower channel line, whatever you decided. You exit when prices hit the opposite channel line, but the question is, does looking at the chat rooms figure in your plans somehow? So it's a very dangerous thing, looking at what other people say. What we do in Spike Trade is based on a book that shocked me years ago. There is a very good financial journalist here in New York. His name is James Surowiecki, S-U-R-O-W-I-E-C-K-I, James Surowiecki. He wrote a book called The Wisdom of Crowds. And I saw that title and I said, wisdom of crowds? I thought crowds were dumb. Well, it all depends on how crowds are organized. The intelligent crowd is the one where people take decisions independently, and then the people who run the group just kind of bring those decisions together. In Spike Trade, where people compete for the best picks of the week, the site is goes under embargo on Friday at 5 p.m. It's under embargo right now. It's going to open at 3 o'clock, at 3:15 on Sunday. So everybody submits a pick for the competition, not knowing what other people are submitting. At 3:15, the site is open. Ask your questions. Some years ago, I became friendly with this fellow, Joe Granville. He was a fascinating guy. He really put volume on the map, and we'll be talking about volume later today. But he used to move the markets. He would speak, and the Dow Jones would jump 40 points, which was a huge number in those days. In any case, Pat and I went to visit him in Kansas City a couple of years ago. He was 90 and was complaining that the management wouldn't give him a 15-year lease on his apartment. He got only a 5-year lease. In any case, he only turned on his computer when it was time to send out his newsletter. Otherwise, he watched his quotes on the TV, on the CNBC, on TV, where they have the tape running. So he had a TV set with a towel over the TV and sound turned off. And so all he could see was the running tape below the picture. You have to isolate yourself from the crowd. the remedy from being swept up in market hysteria is make decisions alone and don't talk your book. Talk your book meaning don't tell other people what you have. It's not a good idea to share what you have, because if you tell them, I think Tesla is going up and I bought at $215 and it's now $225 and oh, and then Tesla goes down to 214 and 205 and your friends start calling and saying, hey, what about the Tesla thing? Oh, it's a pullback, it's a buying opportunity. Now it's down to 195. What about the Tesla? Oh, it's a pullback. Friends stop calling. Tesla is at 170. And you realize it was never a buy, it was a sell from the beginning. Why didn't you see that? Well, because you told all your friends it was a buy. Now you're protecting your thing. So don't talk your book. It's perfectly fine to have friends and to discuss your trades with friends after you close them. I often get emails from people saying, oh, I'm interested in such and such. What do you think of it? This friend of mine writes to me and says there is this company that he thinks is the greatest buy ever. It's e-cigarettes. E-cig is the company. I wrote back to him. I said, I think you don't need to buy. You need a cold shower and then sell everything. It's a dying stock on its way down to zero. I think he wrote to me. He thought Tuesday was the turnaround day. Well, Tuesday was here. It doesn't seem to have turned around too much there. But in any case, peaks come in, and I will pay attention to those peaks, and I'll respond. And sometimes, when I'm trading something that I really like, I will send it to a couple of friends with whom I share peaks. But it's fine to do that. But you make your own decisions. If a peak comes your way, you work it up in your own trade system. But once you have the trade, there is no more talking. We're starting to move towards technical analysis. And the question really is, what is technical analysis? What are these charts? Well, the reality behind these charts is that there are people. Behind every single dot on the screen, there are actions of two individuals. There is a guy who bought and a guy or a gal who sold. Right? There are two people behind every trade. And you can, oh, what about algorithmic trading? Well, those algorithms are programmed by someone, aren't they? When we're looking at the charts, we're looking at footprints, and those footprints can be very messy or they can be very organized. Charts can be trending or charts can be caught up in congestion zones. Very easy to see all of them in the past, very difficult at the right edge. Is it a congestion or a trend at the right edge? That's the question we'll have to tackle later today. But prices are the footprints of bulls and bears. So when we analyze charts, we analyze mass behavior. This is the formula, really. This is the formula on which I think technical analysis stands. Each price reflects a momentary consensus of bulls and bears. Since we're talking about Tesla, let's take a look at the Tesla chart, TSLA. We'll look at the Tesla chart, and let's, well, this happens to be a daily chart, but let's go here, 5-minute chart. Each bar represents 5 minutes of trading. We can slice it even thinner. We can go to 1-minute chart. I don't think my software allows me to go any finer than that. Oh wow, having a nice rally in Tesla here. There was no rally on the daily chart, but you slice and dice, and eventually that's the danger. You slice and dice, you end up seeing what you want to see. So you have to have rules for your slicing and dicing, which we'll be discussing later today. But on this 1-minute chart, I just want to say to you, behind every single dot, never mind the bar, behind every single dot, there are two individuals. There is a buyer and there is a seller. Right? And the last price on Tesla was $223.70, $223.70. So if somebody thought it was worth more, they would have stepped in and bought it. And it would have been 71. Or if somebody thought this was overpriced at that moment, they would have sold it short or sold it, and price would have been a penny cheaper. So each price is established in balance, in this balancing act between buyers and sellers and undecided traders. If you're in a mood to buy or to sell short Tesla, and I would belong more to the second group, I think, then, and you have money in your account, then you're a participant in Tesla, even though your trade isn't there. The people who are buying and selling it know that they better move fast, because if they don't move fast enough, you're going to jump in and take away their bargain. And so every single dot on your screen represents actions of two individuals surrounded by the market crowd. And so each dot is a reflection of the consensus of the entire market. So as we come back to our PowerPoint, each tick represents market consensus for the entire crowd at that time. And when you're buying or selling, you're actually being very courageous, because the entire market crowd said, this is worth so much. And you're saying either, nah, I think it's worth less, or you're saying, oh, that's cheap, let me buy more. So you're arguing with the entire market crowd.